And we have finally arrived at the fateful juncture where the Fed is going to tell us, essentially, not in direct terms, of course, whether the stock market is going to finish the year with cheerful disposition or something else wholly opposite to that. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to, of course, spend the next almost half hour looking at what will come to us by way of the Federal Reserve's monetary policy announcement in the next just less than 24 hours, as a matter of fact, and see how the markets might respond and indeed what the Fed might actually do here with what it is going to announce. So we'll take a look at the price action going into this announcement here first and foremost, and then consider what the reaction functions might be across the major assets. And see what we might divine from there. So this is what the markets did today. And not surprisingly, it's kind of a hodgepodge. And the markets are very clearly not showing a meaningful level of conviction. We can see the S&P 500 a little bit lower, NASDAQ a little bit higher, slightly higher on yields across the board. In particular, it seems like at the front end. And what that appears to be is this continued lowering of the bar of what the markets would consider as acceptable for the Fed's announcement. And we'll get in just a moment to why the markets are needing to give the Fed something like an out on what they're forecasting here. But as we look across the major assets here, there's really not an immediate sort of level of conviction. Gold's a little bit higher, but ultimately not getting very far. Bitcoin's a little bit higher, but ultimately within its recent range. The dollar is a little bit stronger, which you might expect would be the opposite of what would happen in an environment where the markets would be saying, oh, we have these anti-fiat, anti-dollar proxies higher. At the same time, you wouldn't expect those proxies to be higher at a time when yields are up, which the dollar is more consistent with. Crude oil continues to be on a mission all by itself, seemingly ignoring everything else, inching lower once again in a kind of stubborn, choppy, but persistent stair step. And so the markets are seemingly disconnected from macro dynamics here of a unifying sense and looking instead like they're just kind of buttoning up exposure and getting the trenches ready for what is coming up when the Fed actually delivers their announcement tomorrow. We can already see in last week's performance some of this. For example, we can see Bitcoin stalls, gold stalls, but the dollar is weaker, even by a touch. Stocks start idling, but yields are up. So you get this sense already with the way the markets were kind of struggling for momentum last week after, of course, the spirited risk-on rally the week of Thanksgiving, where stocks were up a bunch. We can see that here. At the same time, gold was up and Bitcoin was up, and there seemed to be a lot more consistency. Dollar was weaker. There seemed to be a lot more thematic consistency. Now it seems that thematic consistency just isn't there, and we've arrived at a place where the markets are instead concerned with getting themselves ready and reluctant to make up their mind until after the event risk has passed. Now, what of that event risk? It's not much of an event risk. it would seem, if what we're focused on is whether the Fed will actually move rates at this meeting. That seems increasingly like a foregone conclusion. The likelihood here that the Fed is going to cut rates by 25 basis points at this point looks like essentially a given. When we have this kind of a high setting here, 87% likelihood that the Fed is going to make the move, it's essentially unheard of that the Fed wouldn't be doing what this level of conviction is implying. And so what that would suggest is that the action really isn't in what the Fed does, but much more so in what the Fed says. Moreover, it's not as though the likelihood has meaningfully changed recently. So this is not newfound conviction that's still percolating through the markets. This is conviction that is quite well worn at this point. A week ago, we were already north of 80% and very close to current settings and have largely held exactly there. So there's really not a whole lot here to speculate on. Rather, the speculation seems to be here. And what we see is, while the outlook for this year has basically become something of an afterthought because we already had a pair of rate cuts, and so most of what the Fed has told us they would do when they last updated their intentions in September, this was it. This is the summary of economic projections from there. It starts with a median Fed funds rate of 4.4. The Fed says, we'll give you a cut and we'll project 3 cuts for this year from 4.4 to 3.6. By this point, we already have 2 of those cuts, of course, September and October. And as we just saw, the likelihood of a third is well north of 80 and approaching 90%. So this part of the outlook, that's a given for the most part. The controversy is in here, where, as we can see, the tally for this year and next has been shifting up, largely because the market has been factoring out rate cuts for next year, down now to narrowly favoring 2 cuts. So we're just at about 50 basis points, a little bit light, of course, but those are mainly rounding errors. So we're at basically 2 cuts. And that is a significant change from last week, where we got up as high as 65 basis points and averaged around 61. So we hovered last week, and really for the most part, the past 6 months at well over 2. And we've kind of vacillated between will we have 3 or won't we? The likelihood there has moved around some. But we would have to go back to mid-year to see comparable levels of rate cut intent for next year, where the markets thought, oh, we're probably not going to make it very much past 2 cuts. And still, this is more dovish than what the Fed itself is forecasting, which is 1 cut. Now, why is the Fed reluctant to be cutting? Well, we can see it clearly from its communication. The big story, of course, came on October the 29th, the last Fed meeting, when Fed Chair Powell very clearly said that the balance of risks has now shifted after the actions in September and October, saying, look, we don't know what the data from before the shutdown is going to look like. We know that labor demand has softened. Ostensibly, that's why the Fed is acting. Balance of risks shifted unemployment, so we took a more neutral stance. That much is clear. This was really the part that got the markets in a huff. There are different views about how to proceed at December, and there are strongly differing views. And a further cut in December is not a foregone conclusion, far from it. Now, the markets have decided that it is a foregone conclusion by this point. Of course, quite some time has elapsed. But what we know here is that the board seems finely balanced. There's not seemingly strong consensus. We have here this further clarification from Powell where he says September and October, when he says today, that's what he means, were risk management cuts, and that's not the case going forward. We don't know what data we have in December. What do you do if you're driving in the fog? You slow down. And so that's perhaps why the Fed is inclined to just say, look, we are minded in the direction of rate cuts and not rate hikes. We are, generally speaking, in a direction where if we're doing anything, it's cutting, but we don't have the kind of data to jump out the window with conviction. So instead, here is a single rate cut. It stays on the board, and that should tell you where our head's at, but actually, we'll get back with you on what scale actually looks like. And that seems to be what the majority of the committee was worried about when we then got minutes from this same Fed meeting, where you can see most officials see more cuts as likely over time. So again, a statement of intent here. Several said that a rate cut in December could be appropriate. Of course, now we learn that it's most likely going to be the case. But many others, several versus many is an important distinction here, by the way, in terms of Fed minutes language. It is a very deliberate indication of scale. Many others felt rates could remain unchanged for the rest of the year. Most officials, right, as in more than many, where many is more than several, warned that additional rate cuts could risk embedding higher inflation. So again, very, very finely balanced. And we haven't had the kind of data, which is, of course, the Fed's point and Powell's point from the onset, to know which side here actually is going to prevail on evidence. We haven't had that much evidence. And so when we get the sense that the Fed is concerned and may not deliver, what do we see? When Powell makes this statement here is when stock markets make a top. Now, they haven't sold off in any kind of aggressive way, obviously. This attempt at moving lower found support at the former low back here, and we've since rebounded to basically where the market made up its mind about this Fed announcement from October and said, yeah, we don't like it, go down. And so we're sort of back to October's starting line here. The dollar has been a little bit more responsive. And we can see here that it's had a little bit of a pullback, but in the broader sense, it is not like the dollar is running away with any sort of aggressive easing expectations, nor is it really benefiting as rate cuts get hemmed in. In fact, since we got this most recent dovish adjustment here, the dollar has actually come down. And so it seems to be more so focused on sentiment than it really is on anything else. Now, does the Fed have a case out of the data that we've seen so far to push for rate cuts and give the markets what they want? Or are they more inclined to essentially continue what they've been saying, which is to say, look, we don't know, and we're going to take it slow while we don't know. S&P Global PMI data has shown that things have remained relatively well anchored, growth rebounding from the weakness earlier in the year and holding near some of the better levels that we saw at the end of last year. The ISM PMI data showing us that while manufacturing remains anemic, it's not really accelerating into a bad direction. Meanwhile, services, which is a much larger part of the overall economy, that's holding up reasonably well and even finding a way to accelerate a little recently. Looking at the main inputs from what the Fed looks at, sort of the dual mandate side of things, again, relatively steady on labor markets in manufacturing, both, by the way, services and manufacturing shedding jobs. Under 50 on this PMI data points to contraction. So both shedding jobs, but at least for services, the pace of shedding is easing. The way that this data works is under 50 is contraction. The further you go below 50, the faster the contraction. But of course, when you go from lower readings to higher ones and you're still under 50, then the pace of contraction is actually decelerating. And that's what we seem to be seeing here. So again, the Fed's already given us 2 cuts. It can take between 12 to 18 months for a single cut to work its way through the economy. Is there an emergency here? Maybe not. Does the Fed need to continue to do maintenance here? Maybe not. Looking at the pricing component side of things, not great, still relatively elevated, but lower, not higher. So perhaps this gives the Fed a little bit of confidence to be cutting this time. And maybe indeed the price of cutting this time on such a finely balanced committee will be that the outlook for next year is not meaningfully changed. And that's how you get consensus around a decision. Indeed, this most recent data that we got on consumer confidence showed us that consumer confidence actually perked up a little in the first look for December, and consumer inflation expectations fell to 4.1%, which is the lowest that we've seen since essentially February, since before the inflation-minded surge in inflation expectations really took hold. Now, it's understandable why the markets don't think that there should be a barrier to rate cuts. They are looking at inflation expectations as hovering near the same lows as we saw in early April. This is the 5 and the 10-year break-even rates. These are inflation expectations as they are baked into the bond market. And of course, in April is when we had the most recent lows where we had this sharp decline in inflation expectations because the markets were convinced that reciprocal tariffs were going to crash the economy. Until, of course, the White House decided to back off. The rebound here, both in stocks and in break-even rates going into the middle of April, is immediately after you get that Liberation Day announcement where the markets decide that this is going to be an absolute disaster. And then when the dollar, stocks, and bonds fall together in very quick succession and with significant swings for a few days, the president comes out and says, whoa, 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 things are getting yippy out here. Let's put this whole thing on ice for 90 days. And the fever breaks. We are at similar levels of disinflation concern as we were then. And so what does that mean about the state of demand? Well, the bond market clearly seems to think that something's wrong. But it's not showing up in growth data. So one might understand why the markets would look at this and say, you need to be cutting more next year. Something is wrong with the economy. But the data that we have on the economy as it presents itself, be it here, or be it here, doesn't seem to be screaming out for anything. And of course, we don't exactly have the kind of emergency that the Fed would readily recognize because markets are collapsing, credit spreads are widening, lending is locking up. None of that seems to be immediately discernible out here. So the Fed might be reluctant. And so the markets have lowered the bar. That doesn't mean the Fed is now going to try to get over it nevertheless. And so this really then comes down to whether moving this number to 50 basis points is sufficient. And whether the markets would even welcome that at this point, because of course now that's what's priced in. And if the Fed doesn't do that, if the Fed instead stays at one cut here and says, look, we'll get back to you when there's more clarity, that probably looks like disappointment. And if that's how this ends up turning out, well, then we know what that looks like. When the Fed gives the markets an outlook that doesn't match with what they want to see directionally, even when there is a cut. Risk doesn't like it. And if risk doesn't like it, one might expect that the dollar here would, in fact, find some support, not so much in the yields side of things as in the risk aversion. Exposure-wise here, going into the announcement, I've got something of a balance to the portfolio. So I'm still long gold and still long silver, in this case via the futures, the 1 ounce futures outright, for silver via a call vertical. But I'm also still short an element of risky asset exposure. Still short the second half of my Bitcoin position with later maturities. Still short the S&P through SPY put verticals. I'm getting really short on time here to manage this crude oil position, but as it's for now moving in the right direction, I'm reluctant to take it off until it does the most of what it can do. And crude oil has been somewhat ignoring of the macro narrative, so I'm going to hold it into the Fed announcement, and we'll see how that goes. And of course, I still have my longer term exposure here, EWZ, MSOS. The first one still working as Brazilian markets take a wallop last week around political headlines, but ultimately don't cross any Rubicons. And MSOS is going all the way out to the beginning of 2027, basically expecting that cannabis descheduling might come up in the midterms next year. So this is a very long dated idea, and still a bit long the dollar, still a bit short the pound, still a bit short the euro, expecting that ultimately they find their way lower. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio, looking at the Wall Street close and where things might go therefrom. I'm also writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow, and I'll be joining Chris for Futures Power Hour to go through the Fed live. So definitely come and join us for that. Happy trading, everybody.